Okay, today we're looking at the 10-year bond yield, DGS 10. This data comes directly from the Fed. So if you notice that the yield here is currently shown as 4.06, it's delayed by a couple of days from the Fed. I don't know why they delay it, but they do not provide it in a timely manner. Currently, if you were to look at the 10-year yield reported in the media today, you'd see it's up here 412, 413, 414. What I would point out to you right away is that 414 is a 50% retracement. So from the high over here, you're looking at a high of 498 to a low over here at 330. Half of that would be 414. So from a GAN perspective, that is sort of the most important level that you can watch, because if you get above it, the risk is that you'll continue. If you get here and then you reject that level, maybe the bond rally continues with yields dropping. But if you close above 4.14%, you could have a bond market correction in the works. And the other thing I would point out here is that the blue arrow is Optex Trigger 300, is a computer model from Optima software that I use. And the red arrows are from Optex Trigger 250, another computer model. Now, you might notice that it doesn't work some of the times. You can see these red arrows pointing for a rise of bond yields, and yet, hey, the reality is that bonds continued declining yield, so you had a continued bond rally. But where you get, say, a red arrow and a blue arrow, maybe you have a better chance of a reversal. Same thing here, same thing here, with a little bit of a delay. And we're thinking it might be happening here. But I would, just to be safe, I would wait for a close above 4.14% to confirm that these computer models are actually legitimately calling a big move up in bond yields. So it's not bulletproof. It doesn't work every time. I'm just telling you what the model says. The market can do whatever it wants. I could be wrong. The computer models can be wrong. So 50% mark, that's directly from GAN. And if you close above it, that would suggest the continuation of the bond market sell-off. So there is a risk of a bond market crash if you get above 4.14%. Just keep that in mind. And if you like this video, give us a like. Keep us videos coming. Register to the website gananalysis.net. You get a couple of free reports. They may not be current, but you can, learn some GAN from studying those reports. So good luck in your trading. I hope this has been helpful. And keep an eye on the bond yield. It could tell you what the stock market is going to do next, because, bond yields rise at a time when everyone assumes bond yields will continue to decline because they're thinking, hey, the Fed's going to cut rates in October and December, bond yields will come down, inflation's under control. Well, what if inflation is not under control? What if it's about to pop up really strongly? We don't know the answer. We could be right, we could be wrong, but the market is never wrong. So if you see a yield above 4.4%, know that something big may be happening. It could be the start of a big bond market sell-off, which in turn would cause a stock market sell-off. So a very important thing, if you're trading stocks and you're ignoring what's happening in the bond market, that's a huge mistake. You have to be paying attention to that 10-year yield.